Hey everyone, how are you? I want to welcome you to this very special episode of the HX podcast. Today we're going to do something a little bit different. The other day we had Howard Lindzon, my good friend, the founder of StockTwits, a very successful venture capitalist, on the podcast. And those of you who listened to that episode might recall that he began talking about some of the investments he's made in some of the companies. And he brought up a very, very interesting concept. The concept is what's called direct indexing. It's a type of ETF that allows individuals to tax harvest losses. It's sort of an optimized version. You could almost call it a smart ETF. So, again, if you listen to that podcast, at the time I was like, wow, that sounds really cool. I want to learn more. And so Howard actually put me in touch with Mo Al Adham of his portfolio company, Frec. And we are joined here today by Mo to walk us through this product, which I think, when I heard it, what got me so excited was sort of if you were going to buy a S&P index fund, I don't know why you would ever not buy this. But let's go ahead. Mo, how are you doing today?
Hey, I'm good. Thanks for having me today. Excited
Absolutely.
to be here.
Yeah, cool. So let's do this. Maybe give us a quick, you've got an awesome background with, a lot of entrepreneurial success. Maybe give us a little bit of your background. And then I thought that the genesis, the origin story of this product and this company was really cool and kind of like, for some of our audience might really resonate. So, give us a little bit about your background and the origination or the creation of the company.
Yeah, totally. So I moved to the Valley. I studied in Canada, University of Waterloo. Moved here 2007, really early on in the Bay Area. And I started a company and ended up sort of like exiting that company and helping out with, founding Instacart with Apurva, and then joined Twitter as a lead product manager over there. Met a lot of awesome people. And so I've, sort of like went through the journey myself through my company, which was in the Twitter ecosystem. And that's where I met Howard back when he was founding StockTwits as well. Yep. And, learned a lot from my company, which was doing video for Twitter. It was called TwitVid. And then saw Instacart really grow from like nothing, from a prototype all the way to, a public company. And learned a lot from that sort of like experience. And then, obviously worked at big tech and at Twitter, and sort of like learned what's an awesome, way to work with colleagues. What does a great engineer do? What does a director of product do? And so like all these learnings, I'd kind of skipped that because I started out my journey as an entrepreneur. Okay. So I went and kind of caught up on that and met some awesome people who a lot of them left and came with me here to start Frec.
Welcome. Got it. And then the idea for Frec, that's actually what I thought was quite interesting. So you're a successful technology entrepreneur who has experience with both startup early stage, but then also working at larger technology technology companies. As you explained it to me, and I'm going to paraphrase, but then you do it, you had some success, had some, money from these companies you've been involved in, and started a journey of looking at, how do you maintain and grow that? And we're sort of surprised with some of the stuff you learned. Maybe walk us through that real quick.
Yeah, totally. So my philosophy when it comes to sort of like money and wealth and career is to basically, preserve what you've got in terms of, not being overly ambitious with money that you've already made, sort of like in the public markets. Mm-hmm. Like the money that I've already made, I sort of like want to put it in an index fund, keep the fees very low, and also optimize on the tax, so all the tax benefits, right? So that's sort of what I'm trying to do is, it's a barbell strategy. On one end, I'm trying to just get, S&P 500 returns with the lowest amount of fees and the most amount of tax savings. Okay. Right. And then on the other end, with maybe my time, I'm taking on bets. I'm starting companies or angel investing sometimes with a little bit of money or advising and so on. And that's where my alpha comes from. Right. So it's a bit of a disjoint barbell strategy, but sort of like that's how I decided that I wanted to, optimize. And, for the wealth preservation piece of it, or the, getting market returns, that's where I was struggling before Frec. right? I kind of ping pong through a number of wealth managers. I was like, well, I just want to get like a very cheap way to get tax savings, right, on my investments, with my investments.
Can I say something interesting what you said? Because I think it's a little bit different than what I hear most people say. I hear the cheap fees part of the equation a lot. That's very normal, but most of the time when people are talking about index investing, they don't really talk about taxes. Like it's not like top of mind. How did you come to focus on that side? And then maybe you can start talking about what you guys do,
Yeah, totally. So I was in a position where I was expecting a lot of capital gains. A lot of my wealth was locked up into these private investments that I had done. And these investments were going public or getting some exit and liquidity. And I was getting sort of like, I was learning, learning the impact that a tax bill can have on your wealth.
Yeah.
Specifically, your capital gains tax bill, right? You live in a high income state like California, and
high income tax state. But it is a high income state too. Yeah, it is a high income state also. But let's be clear, you meant to say high income tax state. But
tax state, exactly. Yeah, and so clearly you've got it's a lot. You can pay upwards of 38 and maybe 40% in taxes, even though you factor NIIT, federal, state.
Yeah.
Your all baked in cost is quite high, even for long-term cap gains taxes. And so, when I started paying those bills, I was starting to research, like, what are ways that I could, offset or, sort of like try to shield myself from paying such a high tax bill, and besides moving, because I love it here. And so this came out as a strategy that a lot of family offices, a lot of wealth managers recommend, which is, if you're going to put in money to work anyways in an ETF, in some kind of an index fund like the S&P 500, something passive and market cap weighted, right? You might as well do this other thing, which is called direct indexing, which gets you additional tax savings through, harvesting capital losses, which you can apply towards any capital gains in the future. And they sort of like never expire and they carry forward. Forever.
So let me cut to the conclusion, but then because I want to frame this for people and why I got so excited about it, but then I want you to walk through it. Basically, what you're talking about is investing in a manner where you capture the vast majority, 99% to 101%, as it turns out from our conversation before, of the performance of an index, but at the same time, you're able to generate for a period of time capital losses that could be used to offset capital gains anywhere in your portfolio where you have them. Is that a good, one sentence summary?
Yeah, exactly. It's a bit of a trade-off. There's that tracking error that you mentioned. You capture, and you're basically tracking the index up to plus or minus 1% in tracking per year, right? With that tracking error per year, right? And then what you're getting in return for that is capital losses. Okay. And quite a bit of them, and we'll get into that in a minute. But I can show you sort of like the breakdown. Yeah.
Well, why don't we walk through the product, because we got the base. So again, I just want to say to the audience here, just imagine this. Right now, you own an ETF. You own the S&P 5, SPY. Okay, to track the S&P 500. Let's say that you've optimized for good fees. So Mo's product, Frec, has very, very low fee. But what he's basically saying to you is you can get the same performance as that ETF, but at the same time get, to a certain extent, a free lunch of capital losses that are harvested, tax losses that are harvested that you could use in your portfolio. So why don't you jump into how you accomplish this? I hate using the word free lunch because there are no free lunches, and I know there are some. We'll go through what the cost is here in a second, but this is pretty damn close, and what has me so excited. Why don't you walk us through how it's done?
So maybe the what I want to start with is perhaps for the audience that is watching this show, and I'll speak through it as well, is a quick demo of what our page looks like. And this is a real funded account that I'm showing over here that was started on December 5th. So almost 6-7 months ago now. Okay. And we placed $50,000 into a direct index with S&P 500 that day. And what our experience shows in this demo is we also sort of like pretend that we've invested the same amount of money in SPY, right? So on that first day that we deployed the money, both accounts were exactly the same, SPY and the direct index.
Okay.
And you can kind of track that over time. And at every single point in time, we show you like what the direct index is relative to SPY, right? And if you look at, as of yesterday, close of business yesterday, the S&P 500 direct index, which, by the way, what that means is like we took that $50,000 in the direct index, we split it up by the constituents, right? So NVIDIA was supposed to be X percentage, and Microsoft
maybe
and Apple
can
and
you
Amazon.
explain? So, because let's take a step back for a second, because this is very useful. This is showing us that what you do performs. I'm just looking at the numbers, and I'm looking at the screen here. You know, it looks like I just keep it on that date, 58946 versus the S&P at 58948. So you've actually outperformed the S&P by $26. So this is, if I get that right. So this is showing me that you are tracking the S&P 500, but explain what the actual structure of what it is so people understand.
Yeah, totally. So when so with a direct index, what happens is, you sort of like, we license the index directly, right, from Standard & Poor's. And so we get a feed from them on a daily basis of what every constituent is supposed to be allocated at.
Okay.
Right? So it tells us that, Microsoft's supposed to be, in this case, at 7.02%, NVIDIA is 6.65%, Apple is 6.28%, and we go and allocate the dollars based on these target allocations, right?
Okay.
And then what happens is every day that passes, we monitor how far you are from that target allocation.
Okay.
And if there's an opportunity for us to sell one of your positions to book a loss, and then sort of like what we do is we do that. We sell it, we book the loss, and then we put the money into correlated assets to the thing that we just sold for 30 days because of the wash sale window.
Got it.
The wash sale rule, the IRS wash sale rule, if you're familiar with that.
Got it. So let's take this. So let's say, and I was trying to pull up on my own screen here, S&P 500 components by size. I don't know if you have that up on your screen here, but let me.
Yeah, it's right here. Yeah, this is kind of this is the actual data that we get back from the S&P, so you can tap into each one of the allocations. And
Got it. Is NVIDIA actually bigger than Microsoft as of right now?
It's the target allocation for NVIDIA is 6.65, whereas Microsoft is 7.02. So no, Microsoft is a little bit.
Got it. I couldn't see the target. I saw the current. Okay, so I see the difference between the current and the target. So what you do, you got $100,000, and you go out and you buy. S&P tells you it should be $6, $6,000 of NVIDIA, $7,000 of Microsoft, all the way down to whatever the 500th component is. I don't know, $50 of whatever the company is. And then you go out and you track it, but you're also monitoring gains and losses, that are there. But then what you do is you begin to model out and say, could we take, for instance, I'm just going to do a very simple version of this. And I might get some of this wrong, by the way, but take the top 10 losers and a month in, sell the top 10 losers and harvest those losses, but at the same time, replace those top 10 losers with a basket of something, a derivative. I actually don't know how you would do it, but that would then track them so that your total tracking error would be very low. And then at the end of the 30 days, you might go back into the top 10 losers. Walk me through that, but that's basically it, right? You're looking at the biggest losers and tracking error. You're saying, where do we have opportunities to harvest these losses, but yet replicate the index? And then, so how do you decide what to harvest? How do you replicate? And do you enter back in 30 days? How does all that work?
Yeah, no, this is exactly what it does actually, but it's what it's doing every day is it's solving a formula, and that formula basically tells us, what are the tax lots that we can trade today, such that it's doing two things. The first thing is keeping you as close as possible to the index, and it's maximizing the tax losses. So it's trying to basically solve for two things at the same time. And we have the formula laid out actually under our resources section, under the white paper that we've published. It's every single day solving this equation right here, right? And it's
Okay.
basically the output of it is like we should trade these things, and and we go and trade them every day. So we actually show that in our product. If you scroll down into the live demo and go to a tax loss harvest activity over here, where it harvested $5, but what it did is it sold these positions, and it bought these other positions,
Okay.
right? Because it figured out that selling these positions and buying these other ones is going to get us the most losses that we can today.
Got it.
And it's going to get us as close as possible to the target index.
Okay.
Right? And it's doing that constantly, right? And by the way, this is an expensive operation. It's an expensive compute. It takes about 10 to 30 seconds for the optimizer to come back with a solution, but luckily the price of compute has come down so much that we can do this for every account every day.
Got it. And then, so how many, just curiosity, so all the accounts are basically doing the same thing, I would guess,
Right.
that are tracking the S&P. How many transactions might it do? Is it doing like 100 transactions a day? Is it more like, not that it really matters, but I'm just curious, but is it doing 10 transactions a day? Like, or I guess it'll vary. How do we look at that?
Yeah. So first of all, it doesn't have to do something every day. So every day it's going to try to find a solution, and sometimes it's happy. It's like, I'm good.
Okay.
There's nothing more to optimize. And for the days that it does do something, it's typically sort of like in the range of 10 to 20 transactions a day.
Okay.
Of course, if it's a small cap index, which has got a lot more constituents than the S&P 500, it's doing a lot more. It's trading much more.
How many? So we didn't discuss this before. How many products do you offer right now in terms of tracking different indices?
Yeah, so we have today we've got 4 products. We've got the S&P 500. We've got the S&P 500 Infotech Index, which is just one of the sectors of the S&P.
Okay.
The S&P, the Infotech, and then we have the CRISP indices. So we have the CRISP small cap, U.S. small cap, and we've got the CRISP U.S. large cap as well.
Okay. What are those? I'm not familiar with those.
So so it's interesting. CRISP is it's Vanguard. Indexes a lot of CRISP indices, right? So if you are familiar with VTI or VB or VV,
I'm actually not. So this is the funny thing that you and I discussed, and I think so. It's a weird thing. I ran billions of dollars. I've done tons of privates. I've done all kinds of complex transactions. When it comes to actually a lot of this personal finance stuff, like I was running my own money, and so I never did anything. Yeah. What is a CRISP index?
So it's CRSP. So this is an organization that actually is affiliated with the Chicago School of Booth, and what they do is they just sort of like license out indices. So CRSP.org, right? And they kind of segment the market into different segments that kind of make sense for asset allocators and asset managers. So you can go and license a market cap index that's a mega cap, a large cap, a core cap, a mid cap, a small cap.
So I see here on Bloomberg a CRISP U.S. Total Market Index, which looks
so that
like
one is exactly that one is mirrored by the popular ETF VTI, and VTI. Let me see how much assets.
So, and I'm guessing, by the way, we have quite a few RIAs that listen to the podcast and watch. I'm sure, the RIAs are familiar with this, but it's funny. There's probably this spectrum. I actually have a bunch of people listen to the podcast that like run billions of dollars, a bunch of people that, run, tens of thousands of dollars. And then I've got RIAs in the middle. The RIAs are like, oh, I've heard of all this before, blah, blah, blah. But for the rest of us, it's all brand new. So if you're saying VTI is the CRISP, U.S. Total Market Index ETF. Got it.
Right. It's one of the most popular ones. Yep.
Got it.
And so, we license those. So, eventually you can imagine, like, we want to, in the future, have a full menu for you to choose from, like from any Russell index to any S&P index to any CRISP index to any, it's sort of like, the point is you come in and there's an ETF that you like, and you may choose to do a direct index instead of that ETF, right?
Got it. So again, you've got the S&P 500, you've got the S&P, I'm looking at your website when I'm looking away here, the S&P index, and then you've got, what were the other two again?
the crisp small cap, US
Okay.
small cap, and the crisp US large cap. The crisp US large cap and the S&P 500 are quite similar. There's a lot of overlap between them. But the reason we have that is because we've got customers who are already direct indexing US large cap, crisp, from other providers that want to transition over to us. And so it makes that transition more seamless.
Okay, got it. So a couple other things here. So and we're going to come back to this thing. I want to talk about tax harvesting. I want to talk a benefit. I want to talk about fees. And then, another thing on your website, you talk about, the ability to borrow against your what you've invested in. Walk us through the math on the tax harvesting. And again, I want to cement this home for folks. If you own an ETF right now on the S&P 500, here's a chance to own the same thing with the same performance, but you're going to get tax losses. It's that kind of simple. Walk us through what that profile. You showed me a really cool chart that sort of showed what it would typically look like through a maybe 3, 4, 5 year period.
Yeah, totally. So in general, the number you want to keep in mind with tax loss harvesting is that you can, generally expect to harvest approximately 40% of your investment back in cap losses.
Okay.
Right. So let's make the numbers kind of easy. Let's say you invest $1 million. Then over the course of 10 years, you can expect to harvest $400,000 back in capital losses.
Does that change my basis though in the $1 million? Like
it does. Yeah, it pushes your cost basis down.
Okay.
Right?
So there is a trade-off here, and this is the net present value of money. Is that like my cost basis is $1 million? I would realize the losses. My cost basis goes down to 600,000. So to the extent that I grow to 1.8 million. I now am paying on, in that instance, I picked a random number, 1.4 million of gains as opposed to, 1.8 minus
1.2, right?
Yeah, 1.2 as opposed to 1.2. Yeah. So that is the trade-off that you're doing is getting the gains, realizing losses today versus lower, paying more in taxes because you lowered your basis in the future.
Yeah, well, exactly. So, like, here's kind of the sort of like, I guess the way to think about it as well is it's essentially like getting an interest-free loan from the IRS.
Okay.
Right? Because you're realizing these losses early on, and then hopefully you're holding this core portfolio, your S&P 500 or whatever it is, for a long, long time. Potentially even stepping it up in cost basis if you plan to bequeath a portfolio to, sort of like kids or anything like that. Then that cost basis that you've pushed down steps up, at the time of death, right? But either way, even if not, but the point is you've taken advantage of losses very early.
Yeah.
And you've offset real tax obligations, and now you have real dollars to compound. To invest. Right.
And then why does it, and you're going to tell me some real obvious reason, but on the chart here, and the table's kind of small, so I don't know how well people can see it, but you show that in the first year, there you go. In the first year, it's like 15% of losses, but in year 8, it's like, or it's like 2%. And there's a weird little bump, by the way. I don't know why between 7, 8, 9, 10, but they're all kind of the same. Why does it generate more losses in the initial years? I know there's some easy mathematical thing, but I don't want to hurt my brain thinking about it. You'll tell me.
Yeah, no, it's actually because when you purchase your investment initially, let's say you brought in that $1 million and you bought it today, right? So most of your stocks are today or tomorrow are sort of floating around their cost basis. So they're revisiting their cost basis more often.
Yeah.
Right. And then as your portfolio compounds and grows over time, they kind of escape away from that cost basis. There's less and less opportunity to revisit the cost basis.
Okay. Got it. Okay. So I now am tracking the S&P. I'm getting near-term capital losses. If I don't sell, it's a free loan. Okay. How do your fees compare? Because you had said this to me that they're money high net worth advisors at Morgan Stanley and all that offer this and stuff like that. why? So I guess part of the question is why do it with you and why not do it with, I don't know if Fidelity has this product or whomever, because I'm sure they have something similar, or do they? Why Frec and not Fidelity or Morgan Stanley?
Yeah, totally. So, a big reason is the fees, and we believe that the product today is mispriced in the market, and that it's very expensive and almost too expensive to make it worth the effort to use. If you're paying 40 basis points to a direct index, or in a lot of places, you're paying even more. Like some folks offer it at even 1.5%, right?
Okay.
And I think that's totally crazy. But sort of like, what happens is the math you need to do in your head is like, are the fees worth it?
Okay.
Because you're saving some money, right, on taxes, right? But then you're paying a higher cost than the ETF almost forever, right? For a long time, because you don't want to be ever managing, hundreds of stocks yourself, right?
Yeah.
So you kind of want to trust the manager to be able to offer it at a low price. So we have this interesting sort of like calculation that we've done here. So I guess like, first of all, you have to be comfortable with a couple of assumptions. The first one is that you can actually harvest 40% of an investment in losses. And,
okay.
It's not just the Frec research, but also Vanguard has a paper on this that shows that you can harvest 40 up to even in some decades, like 80%. If you're invested in 2008, for example,
okay.
or 2000 to 2010, you've had like two big crashes, right? So you harvested a lot more losses.
Oh, that's fascinating.
But let's say on average 40%. And then you do have the second thing that is sort of like just absolutely needed is that you need to have cap gains outside of this core portfolio. If you don't have cap gains outside, don't expect cap gains. Like it's just not worth almost like even caring about the losses,
I have a
right?
funny story. When I closed one of my hedge funds like a decade ago or something, I ended up with because of the way that it ended up, I ended up with like 400,000 of capital losses. That kind of like when you it's these moments in time, and so it froze it and like pushed those losses out to me, and then I just wasn't. I went to another hedge fund. You weren't actually allowed to make any other outside investments, so all of a sudden I literally sat on like $500,000 of capital losses for like 7-8 years because I had nothing to do with them. I couldn't use them. So you have to have the capital gains. Okay, that makes sense.
Yeah, I wish they adjusted them for inflation, but no, that doesn't happen today. Okay, so say you've you have you invest you want to invest $1 million, right? And you are choosing between buying the ETF or a direct index.
Okay.
Right, and the difference, and let's look at the difference between a 10 basis point difference between an ETF and direct index, or a 25 or a 40 basis points or a 75. Frec is actually way less than that because we are priced exactly the same as the ETF. SPY is almost, well, not exactly close because SPY is 9.45, we're 10. So we're like half a basis point more. But just to illustrate this point, what this chart is showing is sort of the difference between buying an ETF and buying a direct index. And let's take the 75, the person who's paying 0.75%, right? What happens is, you're harvesting the losses in the first 5 years, most of them in the first 5 years, like we showed in the other chart, right? Like about, you have 40%, but like maybe you're getting 30 out of the 40% in the first 5 years. So you get all the benefits up front, and assuming you do offset, all the taxes, cap gains, and you take the tax savings and put them back in your portfolio, right? At 75, but then you're paying 75 bips on that, right? So what happens is your portfolio is growing, and sort of like you're paying the 75 bips every single year as your portfolio grows, right? So as your $1 million portfolio becomes worth $2 million, your fees are sort of like growing with that, right? And so at some point,
and just real quick, let me just say, I know a lot of my audience, a basis point is 1/100th of a percent. So in Wall Street, just to, instead of saying 75 100th of a percent, we say basis point or bips, or, I know a lot of people know that, but there's a lot of people who don't. So 0.10%, the Frec fees are 10 basis points. And that's how they speak in the fixed income markets and across Wall Street. So,
yeah, I guess like, the point is, when this product is offered at a 0.75 or 0.4 or 0.25, it sort of like erodes the value that you get out of it.
Okay.
It's almost like the benefit kind of accrues back to the service provider and not to you as a customer, right?
Okay.
Like the analogy that I like to use is like imagine you got a credit card that charged you 5% every time you used it. Like, would you bother? Like, credit cards would never have taken off, right? And so, I think the same way about this product, at really high prices, like at 0.4 and above, I think this product just stops to make sense. Like, you should just use an ETF and forget about the tax savings.
Got it. Okay, that's that is counterintuitive. I would have thought that at point, and I'm sure the brokers aren't out there bragging about it, that even at a 1% fee, that the tax savings would still be a benefit. But this chart's you surprised me again. Like,
look, it may, like, if you're in a very high tax bracket and and it may for a short period of time.
Got it.
But then at some point it catches up to you, and then you have to exit the strategy.
Okay, because I was going to ask. Yeah. Okay, so we do have some assumptions in here. 30% blended tax rate, which is probably low for a lot of folks, 10% annual return. But I mean, I guess regardless, it comes down to this. I mean, first off, let's go through the three things that I want to talk about here. Number one, your tracking error, you basically are doing what these indices are doing. You showed that. Number two, your fees are as low as anyone out there, if not lower, certainly for this product than anyone out there. So regardless of kind of what the negative impact of higher fees would be, your fees are the lowest. And then lastly, just you have on your website here that people can borrow against their accounts. And by the way, I want everyone to know, this is actually going to be funny. I'm not getting paid for this. This isn't an infomercial. I just thought this was really cool. And Howard's a friend, and I thought I was interested to learn about it, so I thought I would go out and share it with other people. But you said the fees to borrow are much lower than the fees versus the other major brokerages.
Yeah, totally. So this kind of comes back to the problem I had when I first started the company was, when I was trying to, resolve this, I want to invest in a low cost index fund that has tax optimizations. The other thing I really wanted was the feeling that I could access, liquidity when I needed without having to, sell my long-term investments, right? Because obviously the cost of selling is too high, right? Because you're paying your taxes, and you're missing out on the compounding, right?
Right.
And so I wanted access to a cheap line of credit, and you can get really cheap lines of credit today if you're with a really good maybe wealth manager who gets you a good deal. If you're with Goldman, etc. But I wanted sort of like a more of a self-serve platform. I didn't want to have to send someone an email and get the wire out the next day, and sort of like I just wanted to click 3 buttons and get it right. And so we as part of Frec, we offer a portfolio line of credit at the effective federal funds rate plus 1%. So as the Fed rate goes up or down, it kind of moves with it. Today that is at 6.33%.
Okay.
And we're way more competitive than at least the retail pricing on major brokerages out there.
Okay. So I mean, I guess, and again, I'm not getting paid for this, but like when I look at other direct indexing products, you are cheaper and have the ability to borrow at a lower cost against. And I see right below on this website, the FAQ, the minimum to invest is $20K. So I'm going to guess, and I mean, you're going to talk your book either way, but there's really, if you're going to do this, there's no reason for people to really not do it with you because you've got all these advantages. But then when I go to the actual product, I guess why? So if I've got in a tax, because this only works in a taxable account, non-taxable account. Right. What's the point? But I've got $1 million account, and I'm carrying 300,000 of SPY in there. Why would I not do this? Like, what's the scenario? What's the downside of not doing? What's the downside to doing it? What would be my reason why I wouldn't do it? Is it because I think I might be selling? I don't know. Walk me through that.
Well, one big reason not to do it is if you have a lot of cap losses that are carrying forward already, and you don't need more, right? Okay. That's kind of the scenario you said you were, when you transition hedge funds, right? You may not need more. Some other folks yeah, they have like more immediate liquidity needs. Like they think they're going to sell and start drawing down on their portfolio because they're nearing retirement or something like that. And so they, it's not a free lunch. Like you're pushing your cost basis down, right? And so it's great for someone who maybe doesn't need to draw down on a portfolio for a long time. Yeah, those are kind of the reasons. But like otherwise, if you really are expecting cap gains, if you're sort of like, have a long-term, investment horizon, then, I personally think it's a no-brainer.
Okay, great. Yeah. And look, I'm not doing it here. I don't have anything invested in the SPY. I'm using all my money to finance my newsletter business, actually. But it seems like to get signed up, I haven't done the sign up here, but it's just like probably opening a brokerage account. So if someone's listening here and they go, well, damn, I'll do that. I got 100,000 in SPY in my Fidelity account. And, they probably what they're going to do, I'll tell you exactly what they'll do. They'll go into their Fidelity account, take a look and see what options are available for this. They're going to be like, holy cow, he's right. I'm going to pay 3 times the fees and I'm going to, I can't borrow it the same. I'm going to move the money over. How does one get started and do this?
Yeah, so signing up is really easy. It's all self-serve. We support trust accounts. We support entity accounts, like if you're investing out of an LLC or something like that, and individual accounts. So you start the account, it takes a couple minutes, right? You get through onboarding, and then essentially I'm going to show this demo account to you all. There's a transfer tab on top, and you tap on transfers and say, I want to transfer my assets into Frec.
Yeah.
So you can tap on that, and then you can add a brokerage. So you can connect your Fidelity, you can connect your E-Trade, you can connect your Vanguard, put in your account number, and it's just a simple ACAT transfer. You sort of like, if you move in money market funds, you're moving cash, you're moving stock. By the way, you can fund a direct index from stock. So if you have existing, Apple, Nvidia, Microsoft, etc., we built the product such that you can seed your direct index with your existing assets as well.
Oh, interesting. Okay, cool. Well, is there anything else you want to add? And then I kind of want to put a summary on this, but I think we covered a lot of the ground. Anything else that listeners should think about?
Not really.
You can say no. That's always the hardest question. Is actually when you cover all the ground, you ask, "Is there anything else?" People feel like they have to say something.
Yeah, totally. No, I think we covered a lot of good things, and it's well, cool. Maybe the other thing is I would just say that we're very hands-on with our customers. So if someone wants a demo or wants to ask a question, we've got a team of folks who can do that and answer questions and be responsive. So.
Okay, cool. Yeah. Well, look, I did this normally on this podcast. Well, we do a lot of things in this podcast where I like to keep it, very varied. We were speaking with a buddy of mine who focuses on sports collectibles the other day because we have a lot of listeners. Like I grew up with baseball cards, so I was interested in baseball cards. And I think there was fascinating dynamics in that market. Last week we had a technical analyst. The week before we had a stock picker in retail and media. We like to keep it varied. I heard about this. It sounded really cool. I don't have a lot in S&P index funds right now, but if I did and was in this position, it seems like a no-brainer for a bunch of folks out there. And I was sort of like, I think I'm pretty financially sophisticated. I never even heard of this. So I thought we'd take the opportunity to check it out. So folks, if you're interested in this, the website Frec is spelled F-R-E-C. For those that are listening, it's frec.com. We've shared, if you're watching this on YouTube, there's a bunch of screenshots there. But Mo, I want to thank you for taking the time today. And, I hope a bunch of folks go out and check out your awesome product.
Awesome. Well, thank you so much. Really appreciate you having me here today.
Cool. Well, thank you for joining me on the HX podcast, and we will see you again very soon.